Do you ever lay awake at night staring at the ceiling worrying about your credit card debt? Does it feel like those balances are never going to go away and you'll be stuck paying off high-interest debt forever? Well, I've got some good news for you. In today's video, I'm going to share my proven step-by-step plan to help you finally beat credit card debt once and for all. According to a 2022 report by NerdWallet, the average American household has $8,192 in credit card debt. This number has been steadily increasing over the past few years. In 2020, the average credit card debt per household was $6,194. So in just 2 years, it has increased by almost $2,000. There are a few key reasons for this rise in credit card debt. The cost of living has been increasing much faster than wages have been rising. Housing, healthcare, education, childcare, all of these costs have gone up significantly, making it harder for families to make ends meet. Many are relying on credit cards to cover these rising expenses. More people are using credit cards to pay for emergencies. If you face an unexpected medical bill or car repair and don't have enough savings, you may have to put it on a credit card. These emergency expenses are pushing people deeper into debt. Credit card companies have gotten better at marketing their products and luring consumers to sign up for new cards. Many offer tempting sign-up bonuses, rewards, and 0% intro APR offers. They make it easy to get new cards and increase your available credit. Interest rates on credit cards are very high compared to other types of loans. The average credit card interest rate currently sits around 16.3%. That's more than quadruple the interest rate for a typical mortgage or auto loan. This makes credit card debt extra costly. The result is that Americans now have over $930 billion in credit card debt, spread out across more than 176 million credit card holders. And the average APR people are paying across all credit card accounts is a steep 16.65%. If you're carrying balances from month to month, credit card interest can really eat away at your finances. Let's say you have $8,000 in credit card debt at an 18% interest rate. If you only paid the minimum due each month, it would take over 17 years to pay it off, and you'd end up paying around $11,000 in interest costs. The good news is, there are strategies you can use to pay off credit card debt much faster and save money on interest costs. Here are some proven methods. Make a detailed budget. The first critical step is to make a detailed budget so you understand exactly where your money is going each month. Track every dollar coming in and going out. Use a budgeting app like Mint or EveryDollar, or just make a simple spreadsheet. The goal is to account for all your income and spending. This budgeting awareness can help you find opportunities to save money and shift more towards credit card payments. For example, you may be able to downgrade your cable package, eat out less and cook more meals at home, cancel unused subscriptions and memberships, shop at cheaper grocery stores, use coupons and loyalty programs, buy generic brands instead of name brands, brew coffee at home instead of buying it. Even relatively small spending changes of $20, $50, or $100 per month can make a noticeable difference in how much extra you can put towards credit card debt. Every bit counts. Pay more than the minimum due. When your credit card statement comes each month, be sure to pay more than just the minimum payment due. The minimum payment only covers a tiny fraction of what you owe. For example, if you owe $5,000 on a credit card with a 2% minimum payment, the minimum would only be $100. If you only paid $100 per month, it would take over 6 years to pay off the balance and accrue over $2,000 in interest. Instead, try to pay at least double, triple, or even quadruple the minimum if possible. In our example, doubling the payment to $200 would pay off the debt in about 3 years and save over $1,000 in interest. Pay as much beyond the minimum due as you can afford. Even an extra $20 or $50 over the minimum makes a difference over time. Transfer high-interest balances. If you have credit card balances sitting at high double-digit interest rates, look into transferring them to a lower interest card, ideally one with a 0% intro APR on transfers. Many cards offer 0% promo periods for 12 to 18 months on transferred balances. This allows you to pay down debt temporarily without racking up new interest charges. Just be sure to always pay the full monthly payment due so you pay off the transferred balance before the 0% rate expires. If any balance remains after the intro period, the usual standard APR will kick in. Popular 0% balance transfer cards include Chase Slate Edge, 0% for 15 months on transfers, Citi Simplicity, 0% for 21 months, Wells Fargo Reflect, 0% for 18 months, Bank Americard, 0% for 18 months. Check your credit score to see which offers you may qualify for. Then submit an application and begin transferring high-interest balances over to rapidly eliminate interest costs in the short term. Consolidate with a lower-rate personal loan. Personal loans allow you to consolidate multiple credit card balances into one predictable monthly payment at a lower fixed interest rate. This simplifies managing just one bill. Personal loan rates currently range from about 6% to 36%, depending on your credit score and other factors. The higher your score, the better the rate you can qualify for. Even on the higher end, personal loan rates tend to be lower than credit card rates, which average around 16%. Consolidating credit cards into a personal loan saves substantially on interest over time. Top lenders for credit card consolidation loans include Lending Club, Prosper, Upstart, SoFi, and Lightstream. Shop around to compare rates. Most lenders allow you to check rates without impacting your credit score. Consider the debt avalanche or snowball methods. The debt avalanche and snowball methods provide a systematic approach to paying off credit card balances from highest to lowest interest rate or balance size. With the debt avalanche, focus on paying off the card with the highest interest rate first. Make minimum payments on all cards, then put any extra money towards the highest rate balance. This saves the most money long term. The debt snowball method has you focus on paying off your smallest balance first, regardless of interest rate. This gives you small, quick wins to stay motivated. Then you roll the payment amount from the first paid off debt towards tackling the next smallest. Either avalanche or snowball can work well. The key is to line up your debts from most to least, stick to a payment plan, and methodically repay each one until you're debt-free. Negotiate with creditors. Don't be afraid to negotiate directly with your credit card companies. Many issuers are willing to work with responsible customers, especially if you have a good payment history with them. Call and politely ask if they can lower your interest rate. Be ready to move credit card balances to a competitor if they're unwilling to work with you. Just threatening to leave may get them to lower rates. If you have old credit card debt that you've struggled to pay off, you may also be able to settle for less than you owe. This does close the account though. Ask if they'll accept a percentage of the balance, say 40 to 60%, as payment in full to resolve the debt. Avoid new credit card charges. It's critical to not pile on new credit card debt as you pay off existing balances. This undermines the progress you've made. Stick to a budget that allows you to pay balances monthly. Limit credit card spending to essentials only. Consider leaving cards at home to resist temptation. Move daily spending to debit cards or cash. Only use a credit card if absolutely needed for a true emergency, with the plan to immediately pay it off the next month. No frivolous discretionary charges. Get professional help if needed. If your debt feels completely overwhelming, don't be afraid to seek guidance from a professional debt relief company. They can also negotiate directly with credit card issuers to lower interest rates or monthly payments to make debt more manageable. And usually what they charge is much less compared to what the interest would be if you didn't hire a debt relief company. I'll include a link in the description of this video if you'd like a free consultation with one of these debt relief companies that has a great reputation and thousands of positive reviews. Create a detailed payoff plan. Ultimately, creating a detailed debt payoff plan is key to focusing your efforts and tracking measurable progress. Outline all credit cards, balances, and interest rates. List the exact order debts will be tackled in along with the payment amounts. Building a clear roadmap to becoming debt-free helps you visualize the light at the end of the tunnel. You can actually see an end date for being credit card debt-free. Refer back to this plan often, celebrate milestones, and revise the projections as needed when payoff dates accelerate due to extra payments. A concrete payoff plan provides structure, accountability, and motivation. The key is tracking your spending, paying way more than the minimums, targeting high-interest cards first, and avoiding new charges. If you're feeling overwhelmed by credit card debt, take it one step at a time. Make a detailed plan of attack and stick with it. Living debt-free is so worth the short-term sacrifices. Increase your income, Finally, one of the most effective ways to get out of debt is to increase your income. While cutting expenses is important, there's only so much you can cut before you hit a floor. Increasing your income, on the other hand, has no limit. To learn how to increase your income, be sure to watch this video, the video link in the description. By earning more, you can put more money towards your debt payments and pay off your balances faster. Plus, increasing your income can help you avoid going further into debt in the future, as you'll have more resources to cover unexpected expenses and emergencies. So click the video on the screen and I'll see you on the other side.